Welcome to the Friday edition of the Tech Stocks Daily Podcast, where we dish out this week's sizzling NASDAQ stories with a tech twist. On today's lineup, we're diving into Roku's blockbuster earnings that have set the stock market on fire, unveiling how their platform is amassing viewers like popcorn tubs at the movies. We'll also explore Fiverr's ambitious plans to reinvent the gig economy with a live broadcast that promises a new era of work. And for a dose of drama, keep an ear on Integral Ad Science and their double lawsuit turmoil, plus the roller coaster ride of GoDaddy's stock plunge post-revenue report. Grab your earbuds and get ready for your dose of exciting tech stock action. Hey tech enthusiasts, buckle up, because today we're diving into the world of Roku, which has been making some serious waves in the stock market ocean. Let's find out why analysts are buzzing, investors are smiling, and why Roku is the name of the day on the NASDAQ. First and foremost, Roku reported its fourth quarter earnings, and boy did it outperform. The company posted a loss of 24 cents per share, beating the analyst consensus estimate, which predicted a much gloomier 41 cents per share loss. This good news came hand in hand with revenue figures that soared to a whopping $1.2 billion, surpassing the expected $1.4 billion mark. Roku didn't just meet expectations, it smashed them with a classic home run swing. The impressive numbers didn't stop there. Roku's platform revenue shot up to $3.5 billion, a solid 18% jump from last year. For those keeping score at home, that places Roku's average revenue per user at $41.49. Streamers, hold on to your remotes. A monumental 89.8 million households are now on the Roku bandwagon, streaming a colossal 127.1 billion hours. That's not just binge watching, that's hitting warp speed on a space voyage through entertainment. So what's behind this streaming success story? Well, Roku is playing it cool with its agnostic platform, welcoming almost all streaming services with arms as wide as their dreams. One jewel in their crown, the Roku channel, is not just a cool idea. They made it a top 5 streaming platform in 2024. Streaming hours ballooned by an insane 82%. Tapping into households with about 145 million people. They don't call them power users for nothing. But wait, there's more to this strong narrative than past performance. Analysts have been adjusting their predictions in light of Roku's strategic approach. Cushioning expenses under the control of a relentless fiscal iron fist, Roku plans good times ahead. The goal? Positive operating margins by 2026, with an illustrious target for platform revenue and cash flow to rise like a skyrocketing blockbuster premiere's budget. These ambitions light a fire in the eyes of potential investors and inquisitive analysts alike. Not everything is rosy, as expense increases shadow profit escalations. Yet, Roku's outlined pathway to profitability has everyone tuning in. With a guidance predicting a net loss of $40 million for the current quarter and an expected break-even by year-end 2025, Roku is thinking ahead. They've adjusted their trajectory to balance their spending while scaling up user engagement and platform advantage. 14% of Roku's revenue still comes through hardware sales, but the real dynamo lies in their strong advertising and premium subscription strategies. This year, Roku has been flipping the script from crisis mode to comeback king, with an ARPU increase of 4% that finally broke a few years of flatlined figures. All of this success makes Roku a very compelling spectacle in 2024's streaming wars, a modern-day Odysseus navigating ominous streaming seas to reach suitors with eager eyes, bigger budgets, and merry subtract signs. Today betrays a major milestone, more significant than just the heartbeat of NASDAQ's wavelengths. It echoes the sounds of a company realigning stars in the entertainment firmament. In short, Roku isn't just ready for prime time, they're ready for a dynasty marathon. Time to grab your popcorn. All right, folks, today we're rolling out the red carpet for Fiverr International because they've got something major brewing that's got the tech and freelance worlds buzzing. Get comfortable, grab your digital popcorn, and let's dive into what Fiverr's cooking up. Fiverr has announced they'll be hosting a live broadcast straight from New York City on February 18th, 2025. And what's the buzz about this broadcast, you ask? Well, it's set to showcase a transformative new era of work. Yes, you heard that right, a bold new chapter in how we approach the gig economy and freelance spaces. Fiverr, ever the matchmaker between businesses and freelancers, is setting the stage for something potentially groundbreaking. Micah Kaufman, the big boss at Fiverr, aka the founder and CEO, is going to be front and center with an exclusive keynote. What's on the agenda? Insider insights into Fiverr's vision for the future of work and how they are planning to shake things up yet again. The company remains committed to revolutionizing the way folks collaborate, creating pathways that democratize access to global talent and opportunities. Whether you're a small business owner or part of the Fortune 500 club, Fiverr's got something for everyone. In the past year alone, Fiverr has helped nearly 4 million customers worldwide tap into the freelance world, offering flexibility and an adaptable workforce, all at the click of a button. Their platform isn't just about finding talent, it's about providing tailored solutions that can help businesses grow and thrive. With an impressive array of over 700 skill types, from programming and digital marketing to a 3D design and architecture, Fiverr isn't just a plucky startup anymore. It's an essential engine in the modern business world. Fiverr Business Solutions is specifically geared towards large enterprises, providing them with the right talent and tools needed to succeed in this fast-paced economy. So, whether you're looking to create the next blockbuster animation, craft a swanky marketing campaign, or design architectural marvels, Fiverr's ecosystem is primed to support your ambitions. So why is this news bubbling up right now? It's a testament to the ongoing evolution of the gig economy and Fiverr's pivotal role in it. This announcement is not just some run-of-the-mill corporate update. It's a front-row seat to innovative strategies that could redefine how businesses, freelancers, and potentially entire industries operate. So mark your calendars, set a reminder, because on February 18th, we'll all be tuning in to what Fiverr is calling a transformative moment for the future of work. Stay tuned, as this could be the gig economy's next big leap. Integral Ad Science Holding Corp, more commonly known under its stock ticker NASDAQ IAS, found itself in the tech news spotlight today for rather tumultuous reasons. It seems the company's journey has hit a rocky patch, with not one, but two prominent lawsuits heading their way, shaking the foundations like an angry weather app predicting storms on a seemingly sunny day. First up, the legal warriors at Kessler Topaz Meltzer & Check LLP announced that they're spearheading a class action lawsuit against IAS. This firm isn't just playing a friendly game of law firm charades, they mean business. The lawsuit has been filed in the Southern District of New York, aiming to rally those investors who suffered during a period dubbed the class period, specifically between March 2nd, 2023 and February 27th, 2024. It's being alleged that IAS wasn't entirely honest and forthcoming about its challenges, specifically dodging the fact that they were getting beaten down by competitive pricing pressures. Think of it like IAS attending a three-ring circus of prices, realizing they couldn't juggle their once favorable pricing strategies anymore. The complaint brings forward 5 fingers of accusations slapped across the face of IAS's corporate demeanor, alleging that competitors had actually kicked into high gear, forcing the firm into a price-cutting spree just to keep the doors from swinging shut. So much for those motivational 1980s pricing strategy posters adorning the office walls, huh? Essentially, IAS's communication to its investors is alleged to have been the equivalent of offering an umbrella with a million little holes in it. They reportedly spouted materially false and misleading statements about the robustness of their operations and the sunny outlook of the company's future. Hot on their coattails, another legal eagle, Lowy Dannenberg PC, is also saying, "Hold my gavel." They too have filed a similar class action lawsuit, arguing that IAS's stock value slipped and slided because of misleading public statements and disclosures. The rumor mill, or should I say the lawsuit papers, suggests that investors who bankrolled IAS during the class period ended up on the losing side as the truth came raining down, resulting in a steep nosedive for the company's stock prices that probably made an old roller coaster regulator get heart palpitations. So where does that leave investors? Well, those who are staring at spreadsheets looking for paper towels for their spilling finances have the option to become involved as a lead plaintiff. That deadline chimes in on March 31st, 2025, meaning there's room for legal heroes to emerge and represent the aggrieved crowd who put their monetary belief into IAS. In summary, IAS has come face to face with some serious legal action. The company, whether it's willing or not, has to do some explaining, adjust those spectacles, and perhaps, more importantly, strap into a legal ride full of twists and turns. The tech world, ever brimming with innovation, will surely keep an eye out to see how this story develops. Meanwhile, we'll keep enjoying the show from the bleachers, armed with snacks, to see who coughs up the pieces to put this puzzle together. Stay tuned, because where there's tech turbulence, there's always a story buzzing to life. All right, tech enthusiasts, let's talk about why GoDaddy has been making headlines today. It's been quite the roller coaster for the well-known website company, and investors are on the edge of their seats. So what went down? GoDaddy's shares took a hefty tumble recently, plummeting more than 13% at one point, and closing not too far from that. The catalyst for this nosedive was their fourth quarter earnings report for 2024. On the surface, some numbers looked pretty solid. They reported an 8% revenue growth, hitting approximately $1.2 billion, which actually exceeded the expectations they set for themselves. But alas, when it came to earnings per share, they stumbled a bit, coming in slightly below what analysts had projected at $1.42 per share. You know how nerdy we're all about numbers in this tech game. This underperformance shook the expectations market insiders had. To put things in perspective, GoDaddy had enjoyed significant milestones in 2023, largely due to an unusually hefty tax benefit, which padded their profits quite nicely. However, this also means the year-over-year earnings were going to tell a different, more challenging story these days. And like any good plot twist, some GoDaddy investors weren't ready for all the drama without some popcorn. Moreover, heightened expectations had elevated GoDaddy's stock price over the last year. That significant boost in valuation was more about expectations than actual growth metrics. So when those high hopes weren't fully met, the sell-off came rushing in, bringing the stock back to what some analysts, and maybe even those peering over their glasses at their monitors, would call more reasonable levels. But don't be too quick to rule out GoDaddy just yet. Management remains optimistic about their future prospects. They're planning for a 6 to 8% annual growth over the next couple of years. They predict a free cash flow forecast around $1.5 billion for 2025, which could certainly pave the way for some steady expansion. Quite the juggernaut move for a company that's already in every other TV commercial, encouraging you to become the captain of your internet destiny. Anyway, what do you guys think? Is this just a bump in the road for GoDaddy or the start of a downward tech trajectory? I'm really curious to know what's on your mind. Whether you believe they'll bounce back or you see choppy waters ahead, pop your thoughts in the comments below. And remember, with tech, it's never just news, it's a sneak peek into the future. So let's keep the convo rolling, folks. All right, folks, let's dig into some stock strategy talk and focus our lenses on Roku. Now, if you're thinking about investing based on today's news, here's my 2 cents. Given Roku's impressive fourth quarter earnings, which flew above Wall Street's expectations like a high-flying drone over a Wi-Fi-backed amphitheater, I'd lean towards holding or even buying shares if you're a fan of their long-term game plan. Why? Because Roku's growth is showing some robust legs, with revenues jumping significantly and their streaming platform popping champagne as it claims more household screens than some may have thought possible. Roku is proving they're not just surviving, they're thriving in this OTT streaming era. But let's not overlook Roku's journey laid ahead. They're aiming for those golden positive operating margins by 2026, putting a cherry on their strategic revenue targets. Tying their narrative into broader streaming success suggests a company willing to pivot smartly to navigate the choppy waters of digital entertainment. Of course, some dark clouds cast shadows with rising expenses, but the outlined guidance, coupled with strong platform and advertising engagement, is music to the ears of those whose glasses are half full. If you've got the stomach for a little risk and believe in the future of diverse streaming platforms, this could be a compelling buy or hold. However, as Jolly Ranchers know, every sweet drop can have a sour backend with inherent risks. Of course, don't just take my word for it. Dive deep into Roku's detailed reports, consider other analytical perspectives, grasp the grand scheme of macroeconomic tech trends, and make sure you're comfortable with what you deduce. Remember to consult with a financial advisor or do in-depth research before making any investment moves, because plays in the market are as personal as picking which show to stream next Saturday night. Make sure you're tuned in to your comfort levels and investment goals before tagging your name on any stock tickets. Wow, what a roller coaster of a day on the NASDAQ, folks. We've seen Roku soaring on strong earnings, Fiverr gearing up to revolutionize the gig economy, IAS taking some serious incoming fire with not one but 2 lawsuits, and GoDaddy hitting a snag in more choppy financial seas than they hoped for. Each step in the market brings its own drama and power plays, making it clear why keeping an eye on these developments is essential. If you enjoyed today's tech tidbits, don't forget to like this video, subscribe to keep updated with all the buzzing tech news, and share it with anyone else who lives and breathes gadgets and stocks. Be sure to check back in with us on Monday for another round of all things tech. Until then, keep those screens on standby and have a fantastic weekend, Tech fam.